Hi, Arnold. Thank you for being with us today. You cover US banks for Bloomberg Intelligence, and a lot has been going on that side of the Atlantic. So, could you please update us on the state of the US banking system from a stress test perspective?
Oh yeah. So from a stress test standpoint, banks are looking pretty good. I think this iteration, there's been talk about, less regulation going forward with. And I know we're going to talk about the presidency and whatnot, just with like court rulings and a potential Trump win. But I think this stress test kind of it shows that the regulators are kind of flexing their muscle, right? Like what we found is, even though we're coming out of a year where last year it was like we had a lot of regional bank failure, a couple of regional bank failures, and then this year I think we're like, oh, the environment's getting better, right? But what we have is like a couple of banks increasing their capital requirements this year, a couple of regionals, right? What we had this year is the credit card portfolio is getting a little hit harder and stuff like that. So, but net for the biggest U.S. banks too, most banks their capital requirement, the stress losses were a little bit bigger this year, which equates to slightly higher capital requirements for the biggest banks, except for Citigroup. Most of the peers, like a B of A and actually it's mostly Goldman and Wells Fargo, their capital requirements are going up 90 basis points, right? But still the banks have enough capital, so they're doing okay.
Thank you, Arnold. That feels safe. So, my next question to you would be: is considering both sides of the presidential campaign, and that perhaps one of them is closer to the status quo in policy terms, what is, in your view, the potential impact from a Trump presidency on banks and I mean these from a capital structure perspective?
Yeah, we think potential Trump win that might steepen the yield curve, right? And so if the 30-year widens or goes up, that's going to really hit. We find like the longer duration preferreds that might face headwinds given it's a longer duration product. And then in terms of the senior debt, what might really benefit the most, we think, is the equities, right? Equities trade on profitability over the equity base, and so the both those, the numerator and the denominator, might be helped with that in terms of a lighter regulatory touch might reduce compliance costs. They might increase risk taking, so that might increase profits. But yet the equity base, right, like regulation might be tempered in the future, so that equity base might come down a bit. So what you're looking at potentially is higher ROE, and that directly correlates to equity valuation. So that might be the winner versus longer duration preferreds kind of being more impacted. And then in terms of the senior debt, right, we think it's kind of more neutral there, given what seniors might benefit from higher profitability, but then kind of offset by less regulation, where right now they've really benefited from the equity, the amount of equity that the big banks are holding, right? That's been elevated, so that's helping there. But one thing I would say is in terms of like the steeper curve, right? If the front end, right, is where the fixed income investors might favor, and so that's totally within the corporate bond space. That is totally a bank trade, because banks have shorter duration, compared to the overall corporate bond index, right? So they might benefit from, bank bonds might benefit from that trade, right? If they investors choose the front end.
Perfect. Arnold, thank you so much for sharing your thoughts. To our audience, you can find all of Arnold's research on the terminal on Bio Arnold Kakuda Go, or otherwise, you can also find them on our Credit Edge podcast, where Arnold is a regular guest. So make sure you find it on your favorite podcast provider. In the meantime, I'll see you at the next Financials in 5.